$500 million disappeared in a single year. The decision that sparked it was made in a private Discord chat nobody saw coming. That loss wasn't just a headline. It wiped out thousands of retail investors, left a hedge fund's partners bankrupt, and sent shockwaves through every crypto exchange you trade on. If you think Degens only lose on meme stocks, think again. The same recklessness can ruin a $100K portfolio in weeks. So how did a fund once hailed as the king of crypto arbitrage implode so spectacularly? The Rise 3 Arrows Capital 3AC was founded in 2018 by brothers Su Zhu and Kyle Davies. By early 2022, the firm managed roughly $15 billion in assets, a valuation that put it on the same tier as traditional hedge giants. Their strategy was simple on paper: borrow cheap stable coins, convert them into high-yield DeFi tokens, and reap the interest differentials. In the spring of 2022, 3AC's quarterly report showed a 45% return on capital, and their balance sheet listed $2.6 billion in crypto holdings, including $800 million of Luna, $600 million of SOL, and $400 million of Terra USD. The firm's meteoric growth attracted the attention of institutional investors, and by June 2022, 3AC had secured a $2 billion credit line from a consortium of Asian banks. The narrative was clear: 3AC was the bridge between Wall Street and the new world of decentralized finance. The warning signs yet, beneath the glossy press releases, cracks began to appear. First, the firm's leverage ratio, borrowed funds versus equity, had ballooned to 8:1, far higher than the industry standard of 3:1. Second, their exposure to Terra's algorithmic stablecoin, UST, grew from $200 million in January to $800 million by August. In September 2022, the Wall Street Journal reported that 3AC's internal risk dashboard flagged concentration risk on Terra, but senior partners dismissed the alert, citing market confidence and temporary volatility. Meanwhile, a leaked Slack message from Su Zhu to a private Discord group of Degen traders bragged, "We're about to ride the next wave, no one can touch us." The turning point, the fatal decision, came on May 10, 2023. Terra's algorithmic peg to the dollar began to wobble after the Terra burn proposal failed. In a frantic Discord call, Su Zhu ordered the fund to liquidate $400 million of USD and Luna positions within 24 hours, hoping to avoid a cascade. Instead of a controlled unwind, the massive sell order flooded the market, slashing token prices by over 80% in minutes. The fund's collateral, mostly borrowed stablecoins, plummeted, triggering margin calls across all of its credit lines. The collapse by May 12, 3AC's balance sheet showed a $1.2 billion shortfall. The Asian banks that had extended credit demanded immediate repayment, but the fund's liquid assets were insufficient. On May 15, 3AC filed for Chapter 11 bankruptcy in the United States, listing $500 million in liabilities that could not be covered. The fallout was swift. Over 4,000 retail investors who had purchased 3AC's crypto index fund on platforms like Binance lost an estimated $120 million. Several exchanges froze withdrawals of tokens that 3AC had used as collateral, affecting millions of users. Lawsuits poured in from former employees alleging misrepresentation, and the SEC opened an investigation into the fund's alleged securities violations. The aftermath: Su Zhu and Kyle Davies disappeared from public view. In June 2023, a U.S. court ordered the seizure of their personal assets, including a $30 million mansion in Singapore. Both brothers were later charged in Hong Kong with fraud and sentenced to 18 months in prison, though they remain free pending appeal. The fund's remaining assets, mostly illiquid DeFi tokens, were sold off in a court-approved liquidation process that stretched into 2024, yielding only $200 million. The $500 million loss, therefore, never resurfaced. The broader crypto market felt the tremor too. Bitcoin's price dropped 12% in the week following the bankruptcy, and venture capital funding for DeFi projects fell by 35% in the subsequent quarter, according to Crunchbase data. So what can we take away from 3 Arrows Capital's implosion? Lesson 1. Never let leverage outpace your ability to meet margin calls. An 8:1 ratio left the fund vulnerable to even modest price swings. Lesson 2. Diversify and watch concentration risk. Putting 4/5 of a portfolio into a single algorithmic stablecoin is a recipe for disaster. Lesson 3. Transparency matters. When senior leaders discuss high-risk moves in private Discord chats instead of formal boardrooms, you have no oversight and no safety net. The principals at 3AC believed they were pioneers, not victims. The difference between them and you is the awareness of these red flags and the willingness to act on them before it's too late. If today's story made you question the safety of your own crypto exposure, consider a platform that offers built-in risk controls and insurance on stablecoin holdings, Webull's Crypto Suite, which gives you a 90-day free trade period and protective insurance on your balances. It's not a guarantee against every market crash, but it adds a layer of defense you won't get on unregulated exchanges. And if you want more breakdowns like this, deep dives into the biggest financial disasters that shape the markets, hit subscribe. We publish a new, data-driven collapse every week, and you won't want to miss the next one. Criminal or just reckless? Tell me below. Save this video so you don't forget the warnings.